subscribe now and press the bell icon. Never miss an update.
Okay, good. All right, so we'll get started on that. See, business meals is a very, very common expense. You will see it in every tax return. Generally, the rule is that only 50% of it is deductible. Okay, and that's what we had been following until 2020 or 2021. Tanya, when did the rule change?
I think only 21 and 22 they are allowed to deduct 100%, but only on certain condition. That rule is valid only till 12/31/22.
Right. So for last 2 years, there are certain exceptions when 100% deduction is permissible. But see, if the expenses are not very high and all, we should still go with 50% only, because what they're saying is that the meal has to be provided by a restaurant. That's one of the condition. You cannot just get that, something from the grocery store or pre-packaged things and then use it in the office and all. So people technically they can go with 100% deduction, but in case of IRS audits, I mean, they'll have to have full, they'll have to have full, record that they are satisfying all the conditions. So usually 50% is a very safe thing to do. If you are not sure, go with 50% and take that. I mean, IRS doesn't even look twice into it. But if you have 100% is also allowed, if you are very sure that this is 100%, this is going to be this is going to give a good significant savings to taxpayer, we should definitely ask them, like, what are those meals for? Or maybe if there is a $10,000 total meal expense, you see, go through the general ledger, pick up the bigger ones. Maybe there's something for $500, $1,000. At least pick up those big ones and ask client, well, what exactly is this for? Where did you, where was this paid out? For what occasion? What food are we talking about? Because we're just talking about meal expense. Right? So what setting it was done, all those things. And we can see if 100% condition is satisfied, at least for some of those, we can take 100% deduction. Another very, very important thing, just like depreciation, this is also one of the items. Shweta, can you tell what I'm planning to say next? What is the similarity between depreciation and meals when it comes to books and tax and all?
So the profit will be different based on tax returns and also the book profit. I mean, the book profits and tax profits will not match based on.
This is always a reconciling item between books and tax returns. Right? Books financials and tax financials will always see this as a reconciling item, because obviously in the books there will be 100% of meals taken, but tax return will not allow that. Tax return will probably allow only 50%. So the moment you are seeing, when you're preparing 1120 and when you're comparing it with a financial statement and you see, oh, as per financial statement, say profit is $10,000. As per tax returns, profit is $11,000. Why is this not tying? You will be thinking, I have taken every number from financial statement, from this Excel, I've entered it all over in the tax return at the proper place. I don't think I've made any mistake. Still, why is there a difference? You should go and check meals immediately, because say the meals is $2,000, the total expense. You are putting meals as $2,000, but the tax software itself will cut it down to 1,000. It's not like you are going there and putting it as 1,000. Okay, when we are preparing the return, we are taking the specific number mentioned in the statement, in the book's financial statement, and we'll go and put it in the designated place in the software where it says meals expense. The software will automatically cut it down into 50%. If we don't know these rules, we'll get lost. We are like, I don't know what's happening. This doesn't seem to tie. right? And then you can go over each and every item and keep spending hours and trying to see why this is not tying. But focus on something which is very, very apparent, which is very, that should be the first thing to look into. Oh, is there any meals expense? Is there any depreciation? Okay, those things, those are the things that will definitely give a difference. And you would not even understand. And same thing is with interest expense. Interest expense, do not just go and put it into others. Like, 1120, when you start preparing, on the form, there are certain categories like rent or repairs or compensation or wages and all. Anything that we see which doesn't fit into those specific categories, generally what all our tax preparers do, they'll go to that other thing and start putting everything there. Okay, just dump it there. The other is not meant to dump everything. We still have to see if there is no other specific category, it's not related to anything else, then you go and put it into others. But interest expense, there is something, a specific line item for interest expense. We have to put it in there only. Why? Because again, there are certain tax rules. What kind of interest expense is deductible? What can be allowed? Based upon certain other conditions. So if you do not put it in the proper place, software doesn't understand. Right? There's no such high level of AI going there in the software. You go in the others and you put that as interest expense, $5,000. Software doesn't understand all that thing. Software will just think that this is some kind of other expense. It will not go ahead and it will read it that this other expense is actually related to interest. No, it will not do all that thing. I mean, I think we should have software which go up to that level, but unfortunately right now they have limitations. So what we should do is, if we know the rules, we should go ahead and put them in the specific category. Because again, there are certain restrictions on interest expense. It may be deductible, it may be partly deductible, it may be 100% not non-deductible. And I'm not going to spend too much time on that because I don't want to get into that what conditions have to be there in order for interest expense to be deductible and all. That's nothing there is a separate chapter on that. We can cover up that later. But the whole point of why I brought it up is that every expense should go into proper line item. Sometimes it's easy, it's convenient for us, we cannot find anything or it's too much of work to find something, just go ahead and put it into other. That's not the right approach. And that's the reason why IRS starts auditing the tax return. Why? They don't want to see huge expenses sitting in others. Or even if you're putting contracting expense, say $1 million, we should not put like that. If we know that contracting is for offshore people, right? Usually all of our startups will have an offshore development center in India. They may call whatever, when they give us the financials, they may call it as whatever name they want to. They can call it as consulting. I've seen some people, they put that as salary expense. And they say, oh, well, we are paying salary of Indian people. No, that's like Indian team who is working out of India. So we want to put that as salary expense in US books. That doesn't make any sense. When we do it, they can call anything they want to. Okay, they are not CAs, they are not CPAs and all. They have no idea of the US thing. So fine, but when it comes to us, we should understand why are they putting it as salary? Is there really a salary? If there is a salary, where is the 941 form? Where are the taxes being paid to IRS or to any other state? Where are the employees? Is there an employee register? If you don't see any of that, that's definitely not a salary expense. Maybe they meant it to be contracting. But again, it's not a regular contracting expense. We need to specifically put that this is an offshore software development expense. So when it goes to IRS, again, IRS officers are not looking into each and everything. They don't have time. There is a shortage of IRS officers. They cannot pick up every return. So what they do, they use technology. They have their own ways of filtering the tax return. If they see a huge contracting expense and they don't see 1099 against that, they will send out an audit notice. No one is looking into it. The computer is sending out audit notice. You guys are claiming $1 million on contracting expense. You have issued 1099 for only $10,000. What's going on here? We are going to audit you. We need the list of all your vendors now. We need all the vendor contracts. We need everything to prove that this is really a contracting expense. Why get into all these hassles if in the first place, if we can put it properly by telling that this is not contracting, this is offshore development. The moment we use the word offshore development, they know, okay, there will not be a 1099. There is no point even matching 1099 with this because this all money is going offshore. And this is a startup. This is a tech company. So it's very, very normal for them to have an offshore tech center or development center. Similarly, I see a lot of times we put miscellaneous expense, $20,000 of miscellaneous or other expense, something like that. We'll put other. What is all that? I mean, that's we are giving. Actually, we ourselves are putting us into risk by telling IRS, oh, we have $20,000 of miscellaneous. We are actually encouraging them to come and do our audit by giving all this, vague information. Miscellaneous is meant for something which cannot fall into any category. And usually that will be a very small expense, like $200, $300, $400, maybe a couple $1,000, depending upon how big the operations are. So we should pay attention to all those things. Let's not if we do it very, very properly, we put proper head. Similarly, we put tuition expense. A company should not have tuition expense. It's not an educational institution. It's like, why would it's going to have a tuition expense? Maybe put that as education and training expense. Training is fine. All corporate companies will have some training expense. So sometimes we have to just, go and see what is the best we can do so that, or put huge, if we put home office expense, we put $50,000 there. Again, we are giving a hint to IRS that come and audit us. Home office expense is again another area where all these bogus expenses go and sit, and IRS really doesn't like home office expense. So they will keep asking, what is this, what is that? And then months go by, the costs go so high, we have to go through this so much of hassle and stress and all. Okay, now let's convince them for this, let's convince them for that. They will come and sit in the office. We need to be available there. They'll show us this, show us that, give us the access to your QuickBooks. I mean, we should do it in a way we don't invite these things at all. Okay. Still, if they randomly do it, that's fine, which also happens a lot. Like one of our clients just went for some audit, which is absolutely nothing going on in that company. We're on the verge of closing it. Still, IRS audited that. But that's something, when I spoke to IRS officer, I was like, why did you even pick it up? What went wrong? Because I wanted to know the insight. Maybe they look into something and they said okay, this is why we picked you up. You guys are having some unreasonably high expense or something. They said, no, there's no such reason. This is a random audit. So that is fine. That's understandable. Okay. So sorry I deviated from the topic, but that was important because we are in the middle of the tax season. There are going to be a lot of instances when you're working on business taxes, and then you would not know where to put in. It's better, or you will see a lot of, big, huge amount of miscellaneous and other expenses. It's our responsibility. We ask client, what is that for? And, or go through the ledger and see if they can fit into some other description. Okay, we cannot just say like this, okay, client provided and we filed it. I mean, that's I know a lot of CPAs do that. I just don't like doing it. They are trusting us. We are professionals. We are supposed to tell them. We cannot give them this excuse. Whatever you provided, we just file the returns. Then there's no difference between us and any random person who just knows a little bit of software. They go ahead and they just file it. Okay, so business meals, okay, the IRS is denied deduction for any meal expense over 75. So 75, if IRS, if client asks to us that what kind of receipts should I put in record, we should say maybe any meal expense that you are incurring for more than $75, put it in record, have that receipt, or scan it immediately, because those receipts, they get faded, right? After 6 months, you'll not be able to read anything. Scan it and put it somewhere, because any expense, if you're having it for more than $75, IRS, if it's like $5-10 for coffee or sandwich or something, IRS doesn't care about that. More than $75, they really want to know what kind of meals you're having, because meals are usually not that expensive. Okay, so this is also, and this is a very common question. A lot of new clients, they'll keep coming and they'll ask us, okay, what should I do as part of record keeping? What do you guys suggest and all? So we should tell them, like, or maybe to be more conservative, we should tell anything above $50 if you're incurring, whether it's meals or it's something else or it's books or whatever, make sure you're having proper receipt. Okay, put it in the record that this is what. If it's meal expense, at least put it in your diary or somewhere on your email, or your calendar should show that you went out and you had meal with so and so people at such and such place. So it can be proved later on that this meeting actually happened. Okay, we'll go through this example. So, okay, another thing, again, some of the things are very, very commonsensical here. They, it's not like it's related to IRS or US only. It's probably related to every country who has some tax laws. What they're saying is the expense should be directly related to or associated with the active conduct of trade or business. The intention is to get some trade or business, or to go to a potential meeting, or something has to be done. You cannot just go for a friend's birthday party and or throw a party and say that, well, I'm calling some 50 guests, maybe 3 or 4 of them, if we talk, maybe they'll turn into our clients. That's not the purpose, right? There has to be an active conduct of trade or business. So it should be primarily, again, business in nature. It should be directly related with the business. If you happen to go somewhere on a personal flight and you meet someone sitting right next to you, and the person may say, well, oh yeah, you're a CPA, I'll probably need your help in filing tax returns. That's fine. We may get clients like this, but we cannot claim a flight expense or other expense saying that, oh, because I met a client, I want to claim that as an expense. Okay, so there has to be, it's our own judgment. There has to be some reasonableness there. There has to be some, something related to the business. And the meal must occur directly before or after a business discussion. So there has to be a business discussion there. That's how the meal, we should say that we are like, this meal is deductible as a business meal. Attendance is important. We cannot just, like, somebody from the taxpayer office should go. There should be someone from client side. If neither the taxpayer nor an employee is present, then we cannot call that as a business meal. We cannot send our, we cannot send our cousin there and say, hey, you know what, why don't you go and meet that guy? Maybe they will be interested in our business, and just reimburse, just put that as a business meal. The taxpayer has to be there, or someone who is an authorized representative of taxpayer. Entertainment, a lot of this, the TCJA, we talked about this, the new bill that was passed. So they have cut down on all entertainment expenses. They've all become non-deductible, because companies, in the name of entertainment, they were expensing a lot. And as per IRS, or maybe as per, the lawmakers, this is not really a very much necessary expense. It can be cut down. Okay, it's not going to, if there is no entertainment, doesn't mean that business doesn't go on. Entertainment is something side, like on the side, that, okay, there has to be some entertainment activity as well. But they have cut it down on that. Obviously, they're not encouraging more of entertainment expense. But if there is entertainment expense for recreational or for the benefit of employees, or like an annual retreat or salespeople meet, or some like fun activity company is doing for the HR is probably doing for the employees and all, then those are deductible. Okay, not for the clients. Usually, like a lot of money was thrown on the name of clients' entertainment and all earlier. So ownership of facility. Okay, so again, this is like ownership of facility. If the facility is being owned by taxpayer and that is being used for business expense and all, again, that's kind of related. So what they say that those will not be allowed. It has to be paid to somebody else. Okay, then there is a little table here that they've given. What is the cost of travel and all? No, sorry, this table is about the guidance on how to document the deductions. How to document it. Again, at the time of only audit, we will need all these things, but they are giving some kind of idea that how do you document it? Like you put the category here. What is the category? Meals, gift, or travel. Then we have to list down the amounts. What time, if possible, also put the time or the day or something. Then place or description. Where did that meeting happen, or where did the travel happen? And what is the business purpose relationship? Maybe put a table like this and then put it in the column that, okay, I met so and so people, because after 2-3 years you'll probably not even remember whom we met, because not necessarily those people will turn into clients, right? So we may not remember, or even if they turn into clients, we don't remember that this meeting actually happened with these clients. So if any of the client asks us, we can give some kind of template with this, that these are the basic things you should keep in record. Maybe once in a week, sit down and fill up your Excel, or do it once in a month. Go through your credit card and then put all these expenses that, okay, this expense probably for this one and all. Save that somewhere. Same thing with the gift and all. What was the gift given for, date and all. So there has to be a purpose. There has to be a business purpose. There has to be some relationship. Again, a business relationship that shows that this is all legitimate. Okay. And again, transportation, car expense and all that, that's all something we can put in. These are, again, they are giving some kind of a template and all, that for your transportation, especially for miles, how many miles or kilometer. Basically we use kilometer here, but then in US they they measure the distance in miles. So we'll always see how many miles or what is the standard mileage rate and all those things. Okay, so they still use miles, they use gallons, they use pounds, they don't use kg or liters, or kilometers and all. So again, summary of all the quick rules is, it has to be an ordinary expense, it has to be a necessary expense, should be directly related with whatever business you're doing it, and some kind of associated test that there has to be. It is associated with taxpayer, trade, or business, and either before or after there is some more kind of business discussion happening. The taxpayer cannot deduct meal expense that are lavish or extravagant and whatever. That's why these entertainment expenses are non-deductible. But any activity that we do for employees and all, those are still deductible, because those are considered as regular or necessary or ordinary expense. The whole idea is IRS doesn't want to allow huge expenses. Like earlier, if like a client was giving like a $10 million business, They'll probably go out and they'll spend like $100,000, take the client out here and there and all, or maybe book their lavish hotels or tickets and all that stuff. But that's not allowed, because that's again a very vague thing, and behind that a lot of other expenses can be hidden or can be claimed, which are probably not really related with business. Or they may be related, but they may be illegal. Or they may not also be illegal, but they may not be as per the social or moral policy, or against the public interest, right? There was one point that we saw yesterday, that is that in public interest or that's against the public interest or not. So there is no point. So IRS is not going to allow any of that thing. File the receipt. So that's what they're saying, that this is how you're supposed to keep the record. Okay, that she is saving it. Maybe she's writing the name of the person whom she had dinner with, and she's also adding it to some place, like in her record. Either it could be an Excel, it could be a calendar, it could be or maybe she's just scanning it, keeping it. Whatever way she wants to store it, that's fine. But there has to be a proper purpose, which is, if she writes the description, the proper purpose condition is fulfilled. With whom she is having, the name is also there. In case IRS wants to audit, like, she can say that this was the person. And why? Maybe to discuss some kind of art event. Is that related to her business? Yes, because she's an event planner. Maybe she's planning some kind of art event. Okay. So, all right. Sakshi, 3.22.
Yes, ma'am. Qualified meal deduction. ABC and Company paid for a catered lunch for its client during a business proposal. The meal was consumed by the clients in ABC's boardroom during the business proposal and subsequent discussion. This expense is considered directly related to the active conduct of business. This meal qualifies as a deduction. ABC's employees took the clients to dinner at a restaurant after the business proposal. The dinner was paid for by ABC. Thus, the expense is associated with the active conduct of business. One of ABC's employees met up with one of the clients a week later for lunch, and business was not discussed before, during, or after the lunch. Even if ABC paid for the lunch, it would not qualify as directly related to or associated with the active conduct of business and is not deductible.
Yeah. So, Shweta, can you explain? I hope you were reading this.
Yes. So the first point, I mean, the first paragraph, whatever the meal expenses that happened was directly related to conduct of business activities. That is the reason it is qualifying as a deduction. In the second paragraph, employees took the clients to dinner at a restaurant after the business proposal. Earlier it was for business proposal, then after the business proposal was done, they took for a dinner. Even that is associated with the business, and thereby it is qualified expenses. But in the third, if you see, ABC's employees met with one of the clients, which is after a week for a lunch, and during the lunch there was no discussion on business point or something like that. So it will not be qualified expenses, since it is not directly related to or associated with the active conduct of business.
It's quite possible that the employees become friends with client because they're working together, and so they decided to meet. Hey, it's been a long time, let's catch up and whatever, like, okay. So it's quite possible they meet, but doesn't if they're not discussing business, they should not be taking that as a business expense. Quite possible. I mean, that keeps happening. A lot of clients, if we are working very closely with, or very, for a long time, they can become friends. And even if there is no business to basically discuss, they may still say, like, let's just meet up for coffee or something. Again, how do you prove all those things and all? That's different thing. We are not going to get into that. We are just going to focus on what is allowed, what is not allowed. Client can come up with any kind of theory that, okay, this is what is happening. And today I had a call, Shweta and I had a call with somebody, and they're like, oh no, this person is that person is that. He has promised that he's going to join. That's why we are paying for their education expenses. I mean, that's all anybody knows. That's just like, just like trying to make a fool. It doesn't work like that. So I had to just ask very clearly that, is this person related to you? I really wanted to ask this, is this person your son or daughter for whom you are paying tuition expenses and trying to claim it? But I didn't ask that way, but it was very clear. And finally he said, yes, this person is related. And then he's saying, no, but this person is working and we have been running payroll and all those things. How does it matter? You can run payroll for your spouse or kids and all without even having them do like 5 minutes of work. Just put them on payroll. So those things are not deductible, and we need to be able to, like, try to understand what's going on there. So they may come up with any story, but then or at least we need to tell them very clearly. See, like, if you're really insisting, we'll go ahead and take that as an expense, but we are not responsible for it, because we are telling you upfront this is not allowed by IRS. We are not auditing them, so it's actually not our responsibility. Like, we can actually go and save ourselves by saying to IRS that, okay, the client is claiming this thing and we are not auditing their books. We really don't know the authenticity of it. But if they are saying this is an expense, we just put that up in the tax return. But we still need to tell the client that we are not going to be responsible if they start auditing, and because we are telling you what the rule is. Now it depends on you what kind of risk you want to take and all. Okay, I think that was a small one. We're done with it. And we will just get started with another really small one and finish off this chapter. Okay, rental property expenses. This again, any expense which is related to rental property only. Are they deductible, or like, is there any limit on it, or are they active in nature, passive, or how do we, like, where do we adjust them and all? How do we report them on the tax return? All those things we'll just quickly see over there. So first of all, what they're saying is all these expenses are generally deductible. If you are putting up the property on rent and paying expenses for that property, they're all deductible. Generally, they're all deductible. Okay. Again, we have to use our own judgment, our own reasonableness, our own like professional judgment to see what actually is that for. So depreciation, section 179 deduction is possible. Again, a lot of you will not know what is section 179, so we'll not spend too much time on it. But all I want to tell you is section 179 is a big tax break that IRS has given as far as depreciation is considered. What they're saying is, instead of depreciating over a period of so and so years, you just take all of that expense in very first year. Quite possible you may not even have paid for it, right? Because people are buying, if it's a huge expense, they're probably buying it on installment basis, or there are some EMIs and all those things. It's like nobody's going to pay like $1 million right away from their pocket, unless super rich or whatever. So even if it's not paid out, but you can still claim the entire thing as depreciation if the title has been passed and all, and if there are certain other conditions which are satisfied. What is eligible for it and all, we will see in some other chapter, which is just going to be focused on depreciation. What we need to really see here is, how do we call a property to be a rental property or to be a personal property? If I'm staying in a home, like, I mean, for like, 11 months or 11 and a half months, and for 5 days I rent it out, would that become a rental property? Or if I'm not even staying, it's just logged, nobody's staying there, But in between, some of the friends or families and all, and some people, they want to stay there and they're saying, okay, can you give it to us for rent for like a month or two and all, and we'll pay you rent. Has that become a rental property, or would that still be personal in nature? It's very important to know if that is a rental property or not, because all your expense deductions are going to be focused, are going to be based on that decision, whether it's a rental property or not. So what they're saying is there is a law, like this is a 14 days. That's the magic number that you can remember. The property must be rented for more than 14 days. Then it becomes a rental property. What is the minimum personal use? So the vacation home rules apply when the taxpayer uses the residence for personal purpose for the greater of more than 14 days or more than 10% of the days for which the residence is rented. So what they're saying is, this could be a bit confusing, but let's just focus that if the residence is rented for less than 15 days, the rental income does not need to be reported. And obviously, if we are not reporting rental income, we cannot even take any rental expenses. They could be all legitimate rental expenses. They're saying it does not need, they're saying it does not need to be reported. Okay? They're not saying that you just cannot report it. If you still want, you can go ahead and report it if you think your expenses are really high and you want to claim the expenses. But what IRS is saying, if you're just renting it for less than 15 days, don't even worry about it. Just keep it with you. You don't need to report anything. Okay. So we also have to see what is the number of personal days. Personal days meaning the property used for personal purpose. How many days are there? Okay, that will also tell us whether this is a personal property or a rental property. We'll go through some of the examples that will make it clear. And if the taxpayer, maybe it's quite possible that the taxpayer is spending time, full time repairing or maintaining the rental property, and no one is staying there at that point of time. It's being not used for, or maybe the taxpayer is staying there, but a lot of repairs and all these things are going on. So we cannot count those days towards personal use. Because again, there is a rule that if for so many number of days, if the property is used for personal purpose, then we'll just take that as a personal property. Or there is a minimum, wait, it got stuck. There is a minimum personal use days that they have prescribed, or minimum rental use test and minimum personal use test. Okay. So if the property passes the minimum rental use test but fails the minimum personal use test, the property is considered a vacation home. Minimum rental use is there, but it fails the minimum personal use. Then we call it as a vacation home. And rental deduction may not exceed the income which is derived from rental activities. We'll go through some of the examples, then it will, I think then it will be clear. Or yeah, maybe we should go over this table. Rental use, if it's passed, if it's rented for more than 14 days. Fails if it's less than 14 days. Personal use is more than 14 days or less than 10% of the 10% number of days for which the residence is rented. So that's why in the software, when you go to Schedule E, there's a little input sheet. And that's where it is asking you for how many days are you using the property for personal purpose, for how many days it is rented out. if we do not fill that up properly, the software is not able to do this calculation. So it's very important. So sometimes we ignore that part, that okay, don't fill that and all. See, if it's for the full year, if it's for rental use, then there is no problem. Even if you don't fill it, we know it's 365 days rental only. But in the year in which it has been put up on rent, we should definitely count the number of days and all and see if it is satisfying. But again, the rule is that more than 15 days, just take that as a rental property. And let's go over. And if it is failing the personal use test, okay, the minimum personal use test is also there. If you're using so many days for personal use, then it will be a personal property. But what they're saying is it's going through the minimum rental. That means it has been used for more than 14 days for the rent purpose, but it is not been used for the personal purpose. Then we call it as vacation home. That means the person is not staying there. They've just taken that home as a second home. Vacation home is a very, very common concept in US. A lot of people would want to have vacation home on beaches or on mountains, and also when it's very cold, they go to the some place where it is like the weather is better, or when it's very hot, they go to the mountains and all, and they stay in their vacation home. For rest of the 10, 11 months or something, it will be closed. But it's quite possible that they want to rent it out. So what are the vacation home rules? That's what they're talking about. And in the scheduling, when we prepare, there is a specific box for vacation home as well. We can just check that box. We can ask those things to client, that is there a vacation home? But if the client themselves are saying, well, this is where I bought it and full 365 days it was on rent, or I bought it in July and from August onwards until October it's on rent, then we know it's not vacation home. Okay, it is a property which is actually meant only for 100% rental use. So if it is a vacation home, what IRS is saying, if it's a vacation home, then your deductions cannot go higher than the income. You have to stop to make it zero. You cannot go negative. But if it's a pure rental property, you can also claim more expenses than the income. So actually the rental loss can be a negative number. Now, whether you can claim all that rental loss on your 1040 or not, that's again different, because this is considered to be a passive income, and some passive restrictions will come up. That maybe IRS will say, well, we are not allowing you to reduce your ordinary income with that passive loss. Or maybe say that, okay, you have some passive income, so you can reduce passive income with that passive loss. Okay, so, but it is allowed. Actually, it is allowed. You can claim a net rental loss. And if you're not able to take benefit of that rental loss in the current year, then it gets carried forward. Next year, we may be able to use it. But with vacation home, it doesn't happen like that. There's no carry forward. It just stops at zero. And what IRS is saying that, okay, that's it. Like, if you're having much more expenses, then just stop here at zero. We are not allowing any more expenses, because this is not your rental property. This is your vacation home property. So, Vandana, can you read 3.23?
Yes, ma'am. A taxpayer with $4,000 of rent income, $2,000 of interest and taxes, $1,000 of rebates, and $10,000 of depreciation may only deduct $1,000 of depreciation. Please
Explain it, Vandana. Go over the calculation and explain it. Why it's able to take only $1,000 depreciation? It's right there.
Ma'am, can I?
Is Vandana not able to do? Okay, Bhavani, you can go ahead.
Ma'am, here the rental income the taxpayer is getting is 4,000 plus 2,000 taxes plus 1,000 repairs, that is 7,000. So the depreciation is more than the rental income, that is 10,000. So he may
Right.
deduct 10% of it, I think. So it
Yeah.
comes to
So another
1,000.
thing that we need to remember, is what is the order of deduction? Why cannot he claim full $4,000 of depreciation against this income and forget about interest, taxes, repairs, and all those things? Again, I think I didn't. Usually depreciation will go to the end, and again, these things are all calculated by the software. So when you are putting in, all you need to do is you need to put in the expenses into the right box. What is repairs? What is interest? What is property taxes, and all those things? But the deduction, this is the order of the deduction, that first mortgage, interest, property taxes will be applied, secondly repairs and maintenance. Even after that, if some profits are left, then you take depreciation to the extent of the profit, so that you make it zero, but you cannot go negative. Okay, again, we don't have to remember all these things, what order and all, because this is done by software. But what we need to remember is why this is happening. That's what we need to remember. If the client asks you why my depreciation is not coming up, I don't see full deduction for depreciation. It should be $7,000, but I don't see it. Why are you guys not taking it? We need to be able to explain why it is not coming, because that's what the rule is. Okay. Then the last point is not for profit. Again, not for profit. If the rental income is for not for profit, or the rental are given for some not for profit purpose and all, we cannot take it. We cannot make it go into losses and claim a deduction against other income. Neither loss nor carry forward is allowed, because this is actually, we are telling IRS that this is not for profit. So IRS is saying fine. Like, it's very common. Somebody has a home, they say that, okay, I'm going to give it because I'm associated with so and so religious organization or some spiritual organization or some church or temple or something. I'm going to let them use my home. Okay, you guys come and run your school, Sunday schools or something, or do your classes, or use it for some cultural activities. We don't want any rent, but just cover up for the cost. So you're charging like basic minimum and all. That's not for profit purpose. So there, even if your actual expenses go higher than what you're charging, IRS will not allow you to take deduction. Okay, because it's not for profit. You're actually not even paying taxes on that. So why all those things? Any questions here on rental expenses, or on what was the other thing that we covered up? Anyone remembers?
Business meals.
Good, business meals. Yes. So that's it. Then we're gonna start with fourth chapter. Like, I don't think there's anything else here. We have covered up pretty much all the expenses. And fourth chapter, if I remember it right, it's going to be focused on all the adjustments and deductions. I mean, like, not the business deductions, but other deductions or adjustments on the gross income to derive to AGI. Okay. Any questions, anyone? Otherwise, we'll stop here and we'll close on it.